Prepare for the un-inversion. Short-term recession signal just flashed red. Hi, everyone, and welcome to another week of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, it's Monday, so we welcome back Alex, who's been looking at the yield curve situation, which is something we've been talking about for quite a while. But specifically today, she's looking at using the yield curve as an indicator of what we should expect going forward, and it's been quite reliable as an indicator of that. So, well, welcome back, Alex. How are you going today, Alex?
I'm going well. How are you going?
Yeah, very good, thank you. The news today, this piece about the yield curve, we've talked about the yield curve in depth, but can we maybe just start off? It's an area I know I get confused about. I know, anyone watching probably is thinking, we hear this term over and over, and it's really important to what we're talking about today. So can you maybe give us a little bit of an overview again, just that sort of big picture reminder of what the yield curve is and what a yield curve inversion specifically means?
Okay, so when you've got short-term rates and long-term rates, there's more risk associated with longer-term loan. So normally your return is bigger in the long term. So say in today with the current rates at 4%, a normal yield curve would say in 10 years' time, if today's 4, in 10 years' time, I'll pay you 6. So it's got that sort of shape to it. When an inversion happens, it means that long-term debt is priced cheaper than short-term debt, and that graph flips upside down. Now, that happened in the US July 7th. It happened in March initially, and then July 7th, which actually coincided with the peak inflation numbers in the US, it inverted from there. And so it stayed inverted since there. It still is inverted, but when the when the bank collapsed, SVP bank collapsed, there was a massive jump. In fact, it was the biggest jump where the difference between the 10-year and 2-year differential jumped the most it's ever jumped in 3 days in history. So since that they've been looking at those numbers. So it in fact went from about negative 1.1% to negative 0.4%. Now, sounds really good actually, because everyone gets very scared of an inverted yield curve. So, the fact that it's jumping and moving around, people might be thinking this is a good thing. But it's more an indicator that there is a recession coming. So we're not quite uninverted yet, but we are about to be.
Yeah, so historically speaking, those numbers you've just mentioned, you highlighted, they're huge, right? Like huge movements. And exactly what you just said, if people think that, well, it's heading back in the right direction, that's a good thing. But I suppose the issue is how deep it got as well, isn't it? Like that was really, the fact it got very deeply inverted was telling you that things really were broken, which is, I suppose, what we've been arguing the whole time about. The Fed continues until they break something. Those deeply inverted rates are it breaking something. So that all makes sense to me. I suppose what I'm a little bit confused about and need this additional explanation on is this concept of uninverting, because if it's normally uninverted, like that's the normal state of affairs, then what does this indicate? So going back to normal, you would think is a good thing, but you're saying it leads to the recession. So can you give us maybe a little bit more background around that side of it?
Okay, so the uninversion, so an inverted yield curve generally is used as an indicator that there's a recession coming, but that is a medium-term indicator.
Yep.
Whereas the uninversion happens to be the lead indicator, so the short-term indicator. So every time a yield curve has uninverted in the last 3 recessions, within 12 months there's a recession. So this is just in some ways saying it's coming faster, or, it was 24 months in July. Now we're on a 12-month countdown, whatever it is, but it's now a closer indicator. And what it is saying is that things are getting worse now. So debt prices are dropping now, and that is uninverting the inverted yield curve.
So that makes a whole lot more sense to me, because what you're really saying is when people go, oh, there's yield curve inversion, we better watch out. We don't know how long that's going to remain in place, do we? So that's why it's not as useful as a timing mechanism, because it could stay inverted for quite a long time, and it already has been inverted
and there's
for
been
a
some
long time.
huge equity rallies in the past where people go inverted, inverted graph, let's get out. Well, they get out 2 years before actually anything
Before it
happens.
happens. Yeah.
So, the timing's mismatched.
That makes a lot more sense. And this is saying, so what you're saying today in the news is look for it actually coming out of that, because that's the real signal that we're close. So
Yeah.
it's imminent. It really is imminent now that we expect that recession.
And you were talking about a very deep inversion, which we've had, and this quick unwind, which just says that people are jittery, the volatility is there, people are ready to jump out of markets as quickly as they can.
Wonderful. So can we turn that to the thing we always love to talk about, which is gold?
Yeah.
We've seen gold already up near the highs, and we aren't already in a recession by those measures. I mean, we've talked about why we're effectively have been in a recession through this whole time in different ways you look at it. But from this sort of inversion perspective, we're not there yet. Are there any historical parallels that you can draw when speculating on sort of what happens to gold in this environment then?
Yeah, so gold is at a record high. It's at a record Aussie high, probably not US, well, definitely not US. But, we've spoken about this, and I know Ainslie has been focusing on this as well. That's been liquidity. The concept of quantitative tightening in Europe, they've been fairly successful. In America, it has been woeful. So you perhaps say that there's been more quantitative easing than even tightening.
I think I read this morning just on that I think we're now up to 11 months of quantitative tightening that's been undone by the recent liquidity injections that they've needed to make to shore everything up in this banking crisis. So, pretty much the whole year gone.
Yeah. It's crazy numbers. 3 or 4 days of banks collapsing, and suddenly we're back to where we are. So what you could actually argue at the moment is gold's increase has been because of asset repricing, because it's a safer asset. It's probably been held down and liquidity is moving to it. So ignoring that and actually looking at when the last time yield curves inverted and then uninverted. So looking at 2000, the gold price was sitting at $450 an ounce about. Within 5 years, it was sitting at $1,200 US an ounce. So that was about a 2.6 times it increased in the space of 5 years. Then you look at 2009 or 2008, sorry. It was sitting around $1,200 an ounce. So it hadn't moved anywhere between about 2005 and 2008. But by 2012, 13, it was at about 2,300 an ounce. So that was about a 2 times multiple then. Well, right now we're sitting on $1,900 US an ounce. Just putting those multiples against it historically when the uninversion happened. So at 2.6 times, we're sitting on $5,000 an ounce. At 2 times, we're sitting on $4,000 an ounce. And let's, look at it decreasing over time, that multiplier. 1.5 times is sort of still up around $3,500 an ounce. Like the increases that should happen because of a recession, not because of liquidity, should be a huge multiplier from here.
And add those two things together, and it's a pretty compelling argument, because you've got what we would expect as the normal multiplier from this uninversion or the start of the recession, and then more liquidity coming in to support it all, feeding all together. It's a pretty compelling picture, isn't it?
Yeah, the safe haven assets are very compelling at the moment.
Well, Alex, thank you for that today. I think that's really clear. Often when we're talking about these big macro issues, we don't have sort of these definitive statements about what we see happen when we reach certain parts of the cycle. And I feel from that analysis today, it's quite clear where we are in the cycle and what we can sort of expect. And you're not saying in the next week or month, but because like you said, in that first case, it was over the next 5 years, but we have a consistent pattern that when we come out of these situations, we do see, tailwinds behind gold for the next period of time. So thank you for that. I really feel that's useful for all of us.
Oh no, it's good. Well, it's good. Hopefully, it's good for gold prices. You know, it's a safe asset, and everything else has been in a bubble, and arguably it has not been. So
No,
it'll be
and we haven't
interesting
we
to
haven't
see
had
what
all
it
that
does.
speculative talk around it. We haven't had any of that at this
No.
phase. So to be at the all-time highs and with this sort of framework unfolding, I think that's really positive.
Yeah, and just to be clear, the yield curve has not uninverted yet, but it is awfully close. So, you know,
Yeah,
everyone should just be watching out for it. There's plenty of graphs around, and everyone can find it. And yeah, just be wary of when that does happen.
absolutely. No, I'll be watching that closely myself. So thanks everyone for watching. Remember, reach out with any questions or comments on the social platforms. We'll get back to you. That's us for today. Keep watching. There's lots happening over the next sort of few weeks as we see whether this unfolds as sort of been described today. We've got the RBA that was this week, wasn't it?
Tomorrow.
So
Tuesday.
we've got that to watch out as well. Lots happening. We'll be back later in the week to discuss that. So I'll talk to you all then. Bye.